Over the past week, headlines about war have been dominating the news, causing a noticeable ripple effect in the markets. As tensions escalate, the markets are clearly reacting, and you can see it everywhere: monthly, weekly, daily, even hourly, a sea of red across the board. It's hard to miss. But here's the thing: while it's natural to feel uneasy when the market takes a hit, this isn't the time to panic. It's not the time to make rash decisions or adopt a doom and gloom mindset. Sure, the headlines are unsettling, but let's take a step back, breathe, and approach this with clarity. Now, before diving into why I believe there's no need to be overly bearish right now, let's first take a closer look at the market. I want to break it down and give you an overview of exactly where things stand. Bitcoin is holding steady just under 107K, Ethereum is flirting with $2,600, and XRP is hovering around 2.24. Looking at the weekly, monthly, and even hourly charts, it's safe to say the crypto big players are in chill mode, stable with no wild moves. That said, it hasn't been entirely boring. We've seen some exciting spikes both up and down on a few altcoins and even Bitcoin itself. The overall crypto market cap is still flexing at a solid 3.33 trillion, showing the space is alive and kicking. As for the altcoin index, we're still deep in Bitcoin season, but there's a subtle shift on the horizon. Could we be inching closer to alt season? Not just yet, but the momentum is building. We've got a lot of work ahead of us, but let's dive into some key updates. Outside of tracking old coins in the altcoin season index, the fear and greed index is sitting at a neutral 53. Interestingly, it started dipping recently, possibly stirred by some big headline news making the rounds. Things are moving fast, really fast, and the reactions are becoming more extreme. So let's shine a light on what's happening. To be clear, I'm not here to sugarcoat anything or spin it positively. I want to give you the unfiltered, 100% real picture of what's unfolding. Stick with me as I break this down and share what I'm seeing in real time. This is where things are headed, and I'll keep you updated every step of the way. Let's kick things off with Bitcoin and XRP. Honestly, they've been snooze-worthy over the past year, haven't they? Sure, we had that exciting surge last November, but since January, it's been a whole lot of meh. Bitcoin did try to spice things up in April, leading a rally, and even hitting all-time highs, but altcoins, not so much. They've been stuck in the slow lane. Here's the deal. Over the past month, Bitcoin has been just hovering. It's been stuck in a range since its all-time high in late May, showing no real signs of breaking out. As for XRP, its last month has been a mix of a slow downtrend followed by some sideways action. Nothing exciting to write home about. Honestly, I haven't been glued to Bitcoin or XRP lately. They're just lacking that spark. Lately, my focus has been on the stock market, particularly the S&P 500, as we edge closer to a potential new all-time high. Yet, it feels like most people are missing this because the headlines are dominated by intense news from the Middle East. Now, the chatter about the US possibly getting involved is growing louder, signaling a major shift on the horizon. Let me be clear, it's not about glorifying war. Far from it. Wars are tragic and half of them seem utterly senseless. But what I'm really interested in is how these events ripple through the markets. History has shown us time and time again, war often becomes a gateway to printing more money. It's a predictable pattern. What happens when war breaks out? Historically, the M2 money supply shoots up like a rocket. And when that happens, markets tend to follow the same trajectory, going absolutely parabolic. But here's the real question. At what cost? If the M2 supply skyrockets, markets will likely surge too. Yet let's not forget what drives this. War. Lives are lost. Chaos unfolds. The financial frenzy isn't just numbers on a screen, it's a reflection of global turmoil. So yes, the markets react. They boom when the money supply explodes. But it's hardly something to celebrate. This is the harsh reality of how war impacts financial systems. I'm being completely upfront with you. This is the cycle we've seen before. It's not good news, but it's the truth. Right now, the buzz in the retail market points to a 67% chance of the US taking swift military action against Iran. This isn't just another headline, it's a situation worth watching closely. The stakes are high and the potential for escalation into a prolonged conflict is very real, spanning months or even years. But let's focus on what we're here for, the financial markets. War isn't just a geopolitical event, it's a market mover. If this happens, markets could surge with volatility, and yes, there's money to be made, but let's be clear, it's not a cause for celebration. Breaking news, tensions are escalating as President Trump orders the National Security Council to convene on high alert. He's cutting his G7 trip short, heading back to DC immediately. Sources close to U.S. military operations in the Middle East reveal that Israel is preparing to deploy a fusion bomb against Iran, sparking a flurry of activity in Washington. This advanced technology, reportedly stolen from the U.S. in the 1960s, is Israel's most powerful weapon. A fusion bomb delivers devastating destruction with less fallout than traditional nukes, but remains catastrophic in impact. The situation grows more dire as reports suggest Iran's leader may be dead or gravely injured, leaving rogue generals with nothing to lose. Israel fears a desperate retaliatory strike, potentially using nuclear weapons. U.S. forces are now on high alert, ready to respond to regional casualties and provide immediate support to Israel if the crisis escalates further. This whole situation seems to be escalating more and more each day. Can we trust everything we're hearing? Not quite. As I've said before, we're bound to see wild headlines and fear levels hitting new peaks. It's a pattern we've witnessed in past cycles. The truth is, we don't know the full extent of what's happening. What we do know is that tensions are rising in the Middle East, and now the U.S. is stepping into the fray. How far will this go? How big will it get? While the uncertainty looms, we can't ignore the potential ripple effects on global financial markets. This could have a major impact, and it's something we need to keep a close eye on. The big event on my radar right now? The Fed meeting. We're now less than 48 hours away from the FOMC gathering, and all eyes are on what they'll decide. Most people are betting on a rate pause, no changes for June. Some even believe rates will stay steady through July, with a possible cut in September. The truth is, we don't know for sure what's coming, but this meeting is shaping up to be a pivotal moment for the markets. I've been laser focused on this for weeks, and I can't stress enough how much this decision will ripple through the financial world. Whatever the outcome, markets are bound to react. And here's the kicker. This isn't just about the FOMC meeting. The world feels pretty chaotic right now, doesn't it? With conflict breaking out in the Middle East and a ton of uncertainty looming, it's hard to predict what could shake the markets next. So how do we navigate this storm? By staying calm and strategic. First, keep those stablecoins parked on the sidelines. Rash decisions and impulsive moves won't do us any favors. Avoid leveraging positions and instead practice patience. Sometimes the best move is no move at all. History has shown us that markets have weathered many storms, including wars, and the patterns are worth paying attention to. Since 1927, the S&P 500 has shown resilience through times of conflict. War, unfortunately, is a recurring reality when money and power are involved. But if there's one thing we can count on, it's that markets adapt, recover, and press forward. Right now, it's all about riding out the storm and keeping a steady hand. Looking back through history, there's a fascinating trend: wars and the stock market. Time and time again, when conflict arises, the S&P 500 tends to go wild. Why? Liquidity. War often means a surge of money flooding the markets, and this time is no exception. But here's the twist. While everyone's eyes are glued to the headlines about the Middle East, something just as significant slipped under the radar. Earlier today, the US and the UK finalized a new trade deal. That's right, a major agreement was just signed, and almost no one is talking about it. While the world focuses on chaos, big moves are happening in the background. Here's a staggering fact. 7.4 trillion is now parked in money market funds, a new all-time high. That's a lot of sideline money waiting for its next move. But why are people flocking to these funds? Simple: fear. Whether it's the looming threat of a recession, global tensions, or just general uncertainty, money market funds are the go-to safe haven. They offer security, stability, and peace of mind when the future feels shaky. It's like parking your cash in an armored vault, steady, reliable, and ready when you need it. This development is occurring at a time when the DXY is experiencing a significant decline. It is also important to note that this is unfolding while XRP continues to demonstrate an upward trend. Despite ongoing discussions of war and its implications, XRP appears to be maintaining a potential higher low compared to its position in April. Similarly, Bitcoin seems to be holding its low from mid-month, although it remains relatively weak. To strengthen its position, Bitcoin would need to break above and secure a strong close over the 107K level. Currently, we are observing daily resistance around 106.8K, which needs to be flipped. To maintain upward momentum, it is critical to break above 110.5K, as doing so would surpass previous highs, including the high wick reached earlier. Achieving this would position us to target the all-time highs from May. On the downside, it is important not to lose the 102.7K level, as falling below this point would signify a breach of the prior low. This could potentially lead to further declines, targeting the lows from early June around 100.4K. Therefore, maintaining support above 102.7K is essential, while breaking past 110.6K remains a key objective. At present, the market appears to be consolidating within a range, awaiting clarity from the upcoming FOMC meeting and developments in the ongoing geopolitical conflict. These factors are likely to contribute to heightened volatility throughout the week. As we progress past Monday, the next few days may provide greater insight into market direction. In addition to monitoring XRP and Bitcoin movements, particular attention is being paid to Bitcoin dominance as a critical metric influencing broader market trends. It's important to take a step back and look at the bigger picture. We have yet to experience the full cycle of this market season, as Bitcoin dominance continues to rise. Reflecting on historical patterns, we can see similar scenarios. For instance, during the Russia-Ukraine conflict in 2022, which gained significant attention leading up to November of that year, the FTX collapse occurred. Following these events, the markets rebounded strongly. Bitcoin reached its bottom in 2022, while XRP found its low point around the summer of the same year. Considering the current landscape, it's evident that ongoing global events and headlines are creating significant volatility in the markets. However, amidst this uncertainty, I remain confident. Historically, periods of conflict have often led to an increase in the M2 money supply, driving higher liquidity. This influx of liquidity typically boosts assets such as Bitcoin, stocks, and XRP. As we observe the M2 supply breaking out, it's reasonable to anticipate further market growth driven by fresh liquidity entering the system. As Bitcoin dominance continues to rise, I believe we are likely to see significant growth across the markets. However, I must express my concerns about the circumstances driving this trend. I am fundamentally opposed to the concept of war, and it is disheartening to acknowledge its role in the current environment. Much of this situation stems from economic factors such as trade conflicts and tariffs, which are influencing global dynamics. While we must navigate through these challenging times, it is important to recognize that, from a technical standpoint, these conditions are creating a bullish outlook for the markets. I must admit, this environment is not ideal. However, it is the situation we have been presented with, and we must make the best of it. That being said, I hope you found this video enjoyable and informative. If you did, I kindly encourage you to leave a like, subscribe to the channel, and enable notifications to stay updated on future content. Thank you for watching, and I appreciate your support.